Investors often argue about whether capital growth or cash flow is more important for an investment property. Now, capital growth is when your property increases in value, and cash flow, that's the money your property either pays you each week or that you have to put into the property each week. Now, because this is such a common debate, in this video, you're going to get an honest and unbiased analysis of both the pros and the cons of capital growth and cash flow, and who each is more suited towards. That way you can decide for yourself which is more important for you. Now, pro number one for capital growth is that property investors tend to make the most amount of money through capital growth. That's what makes you rich. So Steve and Mary, they're a couple wanting to buy a $1 million property in Hamilton, and if this goes up in value by 5% a year, they'll make $50,000 in the first year. Whereas let's now say Steve and Mary want to earn $200 a week from a cash flow property, they're going to make around $10,000 a year. So let's say they've got a goal to make $500,000 from their investment property. They'd need to hold the property for 10 years if making the money from capital gains alone, and 50 years if wanting to make $500K from cash flow alone. Now, there's a bit more to it than that, but we're using simple numbers to get the point across. Pro number two is that capital gains are largely tax-free as long as you work around the bright line test. So if you hold a $1 million property for 15 years and it goes up by just under 5% a year, you're going to make another $1 million minus real estate agent fees if you sell. Do that, you'll pay $0 in tax. Now make the same amount of profit through cash flow. You're going to pay around $333,000 to the IRD, depending on how it's structured. And pro number three for capital growth is that you can selectively pick areas and types of properties that increase in value more quickly. That's by looking at things like regions that are undervalued, suburbs that are closer to the centre of the city, and finding areas with high population growth. But that doesn't mean that capital growth is always rosy. There are cons too. First of all, you can't easily spend your capital gains. You can't go down the street and buy dinner with it. They're illiquid. They're locked within the house. The only way to access that equity is to sell the property or borrow against it. The second drawback is that it takes time to see the benefits of capital growth. Hey, let's come back to Steve and Mary, the couple buying in Hamilton. Their house isn't going to go up in value consistently by 5% each and every year. There will be ups, downs, and sudden booms, and sometimes their house isn't going to go up in value at all. Well, that's where Steve and Mary are going to have to hold firm, even though they aren't seeing their wealth go up during that period. And the third drawback is that you may have to top up and put cash into the property. That would be if it's negatively geared, which means that the rent isn't covering all of the property's expenses. Now, this is pretty common. The IRD estimates that about 1 in 4 property investors don't make a profit each year from their property. So that's capital growth. Now let's look at the pros and cons of cash flow. Pro number one is that you can spend the money you get from cash flow. You can use it to buy your family dinner. You can use it to start slowing down from work, and you can use it to fund your lifestyle. It's not impossible to fund your lifestyle with capital growth, but it's easier to do it now with cash flow. Pro number two is that cash flow is relatively certain. You can forecast it with reasonable accuracy. You know what your rent's going to be, and your expenses are pretty predictable. So you're not reliant on what the market does. And pro number three is you can use a cash flow property to build your investment portfolio. So you might have a cash flow positive property, which you can then use the cash flow with that to fund the top-ups on a capital growth property. Now, this is what we call a wealth wheel. But similarly, cash flow isn't a one-way street. Firstly, you're not going to make as much money from cash flow as you will from capital gains. Properties geared for cash flow are often things like student rentals, room-by-room rentals, and dual key apartments. Now, these properties only really appeal to investors, not as much to owner-occupiers who tend to bid up the price and give you that capital growth. So these properties go up in value with rental inflation, which is generally a bit slower than the property market in general. Con number two is that you will pay considerably more tax when you target cash flow. And that really means that you have to earn more money to take the same amount home. And that's because through cash flow, around a third of your profit goes to the IRD, depending on how you're structuring things. Under capital gains, you generally keep it all yourself. And con number three is that you have to work for cash flow. You can't just buy a cash flow property without any sort of trade-offs. You'll either need to spend time renovating the property, or you might need to buy a property that is geared for less capital growth, or you might need to put in a cash deposit and not borrow at 100%. Now that we know the pros and cons of capital growth and cash flow, let's talk about which is right for each type of investor. The way you invest in property changes as you move through life. That's the central premise of our upcoming book, Wealth Plan, which is coming out later in 2022. And in that book, we talk about the 3 stages of property investment: at the starting blocks, running the race, and crossing the finish line. And if you want to learn more about what happens at each of those 3 stages, check out this video. I'll drop the link down in the description. Investors who are in the earlier 2 stages need to A, buy their first home, and then B, grow an investment portfolio to build their net worth. They'll then use that net worth to earn cash flow later on. So if you're at the starting blocks or you're running the race, you should generally focus on capital growth because you need to build your wealth. Then, once you're older, once you've built your wealth, you're crossing the finish line. And that's the point where you've already built your wealth, no longer need to worry as much about capital gains, and that's where you focus on cash flow. Now, that's also known as the golden goose strategy. And if you want to learn more about this, as well as all of our other property investment strategies, make sure you hit the subscribe button. We release new videos every Monday and Wednesday. So while there are pros and cons to both capital growth and cash flow, the truth is the right one for you depends on where you are within your investment journey.